Thank you so much for joining us tonight and spending your Thursday evening with us. My name is Jingjing. I'm the Chief Client Officer at Endowus. So I'm going to give a really quick introduction, and then I'm going to invite our panelists from PIMCO Capital Group and Hugh, our CIO, up on stage shortly. Hold on. Okay, just very briefly about Endowus. I know that some of you are clients, but for those of you who are newer, our mission is really to help all of us invest better, to live better, to really bring conflict-free investing, evidence-based advice, institutional access to investment products, and low fair fees to everyone. If you look at the logos on the bottom, these are actually the shareholders of Endowus. And I'm very proud of the fact that Endowus employees on the far right were actually still the largest shareholder of the company. So we are a digital-first wealth management platform. Right now, we manage about 10 billion of assets across the Endowus Group, so across Endowus Hong Kong, Singapore. And we also own a majority stake in Korea, a multifamily office. We started in Singapore in 2017, and we officially launched in Hong Kong last year as well. So in Singapore, we also manage pension money. So that's Singapore's equivalent of MPF, as well as SRS, which is another retirement fund. And we launched in Hong Kong officially last year. So I've shared a little bit of our shareholding structure. So we have about 150 people across Endowus, Hong Kong, and Singapore, and we have a small tech team in India as well. So we work with about 100 plus global fund managers. So we're not trying to be a fund supermarket. So Hugh, our CIO, leads our investment office, and our mission is really we want to curate the best investment products, the best managers, and bring that to our clients here in Asia. Sorry, this clicker is not cooperating today. So that is our Endowus logo, the 3 ticks, right? We want to help everyone manage their short, medium, and long-term goals. So we are a holistic wealth management platform. If you come to us and ask us what our stock tips are for the year, we won't have that answer for you, but we really want to help you grow your wealth for the long term. The reason why we're called Endowus is because we want to bring endowment investing to all of us. And what is that? What does endowment investing really mean, right? It's about taking a long-term view, about being having a strategic asset allocation, and being diversified across asset classes. So we've brought the best in class, both public markets as well as private market solutions to our clients. So when a client comes to our platform, we ask them, what is your goal? What do you want to achieve, right? Because we believe that at the end of the day, it's important that we help clients achieve their financial goals rather than trying to beat the market or speculate. So we help them think about their goals from their short-term cash flow needs to medium-term lifestyle needs, long-term longevity, as well as any legacy planning that they want to do. And then based on what their goals are, the risks, then we advised on what the appropriate asset allocation and what the appropriate investment solutions are. And so when you put all that together, then that is the client's overall asset allocation. If I can click on it, there we go. Yes. So everyone has a unique personalized asset allocation based on what their different goals, what their different liabilities and needs are. And this can span, again, across from cash management, public markets, as well as private markets and hedge funds. Sorry. Okay, so the Endowus platform, we have a very, very wide range of clients. So everyone from individuals to family offices to institutions, schools, foundations, and nonprofits. We really want to bring conflict-free wealth management to all of us. So our services range from being a fund platform where you can customize and build your own portfolio, to investing in our advised model portfolios that are designed by our investment team, bespoke customized solutions for our larger clients and institutional clients as well, and outsourced CIO service. We really believe that there is a market. The market is very underserved now for conflict-free wealth management. So my background personally I was in a private banker. I was at Morgan Stanley, then Nomura. And one of the reasons why I left the industry was because I felt like the banking model here in Asia is extremely transactional driven, and the banks are not always aligned to clients' best interests. Financial products here in Asia are pushed and not pulled. And I felt like, even as an individual, that's not how I manage my own money. I don't feel a need to transact on a daily basis, to trade super actively every day. But unfortunately, because of the way that incentives are in Asia, that's how the banks operate here. So we really wanted to do wealth in a better way when we started Endowus. Lastly, Endowus actually has a super vanilla business model, right? We are a fund investment platform. We don't take any deposits. We don't take any leverage. And what that means is that there's no risk of a run on Endowus, right? So we work with HSBC Hong Kong to custodize for cash. And the custody of the underlying funds depends on which of the fund managers that we work with. But usually it's something like a State Street or BNY Mellon. We have a segregated, we segregate our Endowus operating account from our client assets, so that there is never any chance of us being able to even use client money or assets in that way. And we spent a lot of time trying to figure out how to build, it's really an institutional grade kind of safe platform for clients to invest their wealth in. And with that now, I'm going to invite our speakers on stage. So Hugh is our CIO from Endowus. We have Andrew from Capital Group and Jingjing from PIMCO. You guys can come up on stage. I'm going to first pass it to the speakers to do a quick self-introduction.
Sure. I think I have a mic.
No, this is for recording, so you still need the mic.
Got it. Good evening, everyone. Good to be here. My name is Jingjing. I'm a product specialist based in the PIMCO Hong Kong office. I've joined PIMCO for over 6 years, and even before PIMCO, my focus has always been in the fixed income market for the last decade.
Hi, everyone. Okay, let's try this again. Hello? Yes, great. Hi, everyone. I'm Andrew Lee, Investment Director of Capital Group based here in Hong Kong. And I've been with Capital Group for about 4 years and focusing predominantly on equities as well as multi-asset strategies.
Hi, my name is Hugh. I look after the investment office at Endowus. Prior to Endowus, I was a CIO of a single family office based in Singapore. But before that, I lived in Hong Kong for from 06 to 18, and mostly in the capacity of a hedge fund risk taker in various organizations.
Thank you. Let's start with the question that's on everyone's mind, the Fed and 2026 outlook. So this is a question for all three of you, right? So the Fed began cutting rates this year, third quarter. So as we look to 2026, what is your base case for the Fed's trajectory? Do you expect a steady kind of continuous cutting cycle, more of a stop and grow approach? And what is the biggest implication of this on equity and fixed income markets?
I'm happy to start. At PIMCO, our base case is actually also changing, because you have seen the market and also the data with all the government shutdown that's also delaying the disclosure of the data. I think short answer to your question is we think it's going to be a stop and go. When I'm quoting the Fed chair now, when you're driving in fog, you need to slow down. So our base case is in either December or January, we're going to see one cut. And moving forward until Powell's term ends in May next year, we're probably going to see a pause. And then as the second half, with the inflation moving closer to the target of 2%, we're probably going to see the restart of the cutting cycle. However, no matter what the pace is, we are already in this cycle of rate cut. So what that means to fixed income investors is it's still a very attractive level of the market. The yield level is still very elevated compared to the past history, and it is time to lock in some of that level with high quality assets.
Thanks. So I mentioned earlier on that I'm mostly an equity guy. So after hearing a fixed income expert talk about rate cuts or talk about rate trajectory, and now to me, I feel like it's quite challenging as a setup. But jokes aside, this is how I think about it. I think at this point in time, and first of all, if I think about Capital Group, right, we don't really have house views. But instead, we have multiple and really diversified perspectives about securities, about companies, but also on different macro elements that drive markets. And so how I think about it is that at this point in time, I also agree with what Jingjing had just said. I think very much likely the Fed's going to adopt a stop and go approach, and that's really because if you look at the trajectory of the Fed decisions, it has been pretty much data dependent. And so I think that's going to be the working assumption going forward. But also, I think it's very interesting to look into the different members of the Fed. At this point in time, several regional Fed presidents are a little bit more hawkish. I think they're focusing more on inflation, and if inflation proves to be pretty sticky at around 3%, then the policies, it's already quite loose. And so not a lot more ground for them, or at least in their working assumptions to cut rates. But then if you look at the board members, they are a little bit more dovish. And I think the focus is a little bit more on the unemployment, on the labor market weakness, and there could be more push for them to think about cutting rates before it becomes too late. And so I think, yes, it's going to be stop and go. So what does that mean for equity investors? I think it's really going back to just a cliche saying, 5 words, and that's keep calm and carry on. And that's really because if you look at the markets over the last 2 years, especially if you look at the US markets, we've been through a really high rates environment and then rates coming down, but still equity markets are delivering. And so going into 2026, to your question, it's if you look at a lot of the equity fundamentals continue to be quite positive. So earnings growth is there, it's picking up momentum, but not just in the US, but across the board in the rest of the world. Valuations is a little bit of a concern, especially when it comes to US, but if we can just take a step back and look at outside of MAC 7 or outside of US tech, a lot of opportunities from a valuation standpoint. You also have really powerful secular trends that would continue to go regardless of whether rates is going to go up or lower. So you have AI, you also have healthcare innovation, you also have reindustrialization. So I think these are something that as equity investors should look into going forward and should be excited about.
Yeah. So instead of repeating what the experts have said, and I'd like to say something slightly different, which is that if you look at 2024 and how rate expectations have changed throughout the year, it's around middle of 2024, there was a period when the market participants were expecting about 8 rate cuts in the following 12 months. Subsequent to that, and a few months later, there was about, if I remember correctly, that probably obviously went down close to 0. There were even about a 30% group of people who thought there was going to be a rate hike. So The point here is that no one knows what's going to happen. We've seen that time and time again, and I don't think it's any different. I mean, this year, I think the forecasts and expectations were less surprising. I do think that what the two panelists have said makes a lot of sense. However, I don't think you should base investments just on one singular view on what rate cuts will do, et cetera. And as Andrew has said as well, one of the things that's happening with the dual mandate of the Fed is that on the labor side, you're seeing, for example, the AI developments, et cetera, impacting productivity. So the historical ways of looking at labor is not the same as it is now as well. So there are a lot of different inputs towards how the Fed decides on policy. On top of that, obviously, there's the uncertainty around Chair Powell as well. So I do agree with the base case. However, I do think that from a portfolio construction perspective, you should have much more kind of diversified kind of parts of the portfolio to protect against different strategies.
Thank you. Let me just follow up on the last point that Hugh made on the uncertainty on Fed Chair Powell. So question for Jingjing, right? I mean, his term ends in mid-2026. How much political risk or uncertainty is PIMCO pricing into the bond market in 2026? And can you have any views on how that would affect the Fed's independence and impact to markets as well?
Sure, thank you. So I think from early last year, people are worried about his job security as the chair of the Fed, and now people are more worried about whether he's going to finish his term. But I think our base case is that he will stay with Fed until mid next year. How much is the market pricing in the political factors? We don't think that's a lot. It's more like economic data driven of uncertainties rather than really the purely political factors. And we think it's a tail risk for the new Fed chair to be entirely politically biased. And we also don't think there will be changes to the dual mandates for Fed's decision-making framework. And there won't be, our base case is there won't be much changes to the independence of the Fed. And we are saying that not because we invest in bonds, but also because on our PIMCO advisory board, we had Ben Bernanke, who was the previous Fed chair, who sits on our board until earlier this year. And then the new member of the board is Janet Yellen, who is also a previous Fed chair. So with all these insights, and also our economic advisor is Rich Clarida. He is the vice chair at the Fed, working together with Powell. So with all these insights, that's our base case. So to how much of the market and uncertainties that's pricing into the market, we think it's really the economic data and how much we are foreseeing. We do think going forward, the market will continue to be uncertain. And for investors, it's also very important to understand managing a portfolio is more than just buying a single assets. There will be dynamic management of duration of the curve and diversifying between the credit risk you're taking, the duration, the interest rate risk you're taking, and that's a very complicated and holistic process. So to the point when Hugh was mentioning, there was a point when the market was pricing in 8 times of the rate cut, we were already telling the market it's not going to be the case. And then there was a point when people just thought rate cut is a certainty, and a lot of the investors went on by the long end treasury bonds, 30 years bonds, thinking that this is a no-brainer. But it turned out they probably lost double digit in that market. So a key point is it's more complicated than that. It's going to be a dynamic market. So managing the duration risk and also sourcing the duration relative value from across the world is very important because the headline is dominated by the US Fed. But reality is there's a lot of other developed markets who's also looking to cut rates, who probably have more space and more room to cut. So that's another area that we're taking opportunities, like we overweight the duration in markets like UK and Australia and New Zealand as a way to diversify.
Thank you. And I mean, at Jingjing's point about managing duration, kind of global implications, I mean, that's one of the reasons why we partner with managers like PIMCO, because as an individual, it's very, very difficult to be able to position a fixed income portfolio actively in this manner. So moving to another
area that is a perennial concern for Asian investors, right, which is the dollar and U.S. market valuations. So, question for Andrew, are U.S. equities still the primary engine for growth, or are you seeing more kind of compelling, interesting opportunities in Asia today or other emerging markets that can finally decouple?
Well, first of all, no offense, but I think perennial, it's a little bit of an exaggeration because if we just go back less than 12 months, if we just go back to last year or the year before, US dollar assets have been the darling for most investors, and that is what kind of sort of help underpin the 7 stocks that are related to AI and let the market coin them as Magnificent 7 and now Magnificent 8. And so I think it's only this year, especially after Liberation Day, when we saw the market correction and people and investors starting to question, hey, is US exceptional? Is U.S. dollar exceptional? I think that's a little bit of a shorter term concerns, and again we have different views about how we should think about U.S. And whether U.S. is still the growth engine. But I think U.S. does still offer a lot of great investment opportunities, and it's really underpinned by a couple of structural factors that is, once again, more long-term, not really short-term. I think one is just U.S. economy continues to be really healthy, easy access to capital, and also U.S. has a very unique equity market structure where if you look at the S&P 500 index, 50% of the index is actually new economy sectors oriented. If you look at other developed markets like Europe, Japan, about 30-ish%. And so if you think about going forward, it's really the new economy sectors that are driving a lot more growth opportunities, and US is really the place where you want to be. And then also, I think earnings growth, coming back to the point that, US, there is earnings growth, and I think going into 2026, we're seeing that already this year, but going into next year is that it's not just the tech sector. I know that today everybody's super excited about NVIDIA. And over the last 3 years, I think investors have been quite excited about NVIDIA, but let's not forget about Broadcom. It's been doing very well. And there are actually a lot more sectors participating in that earnings growth story. And I think that's really where I think US should continue to offer great opportunities, and investors shouldn't be writing US out. But then if we take more of a global perspective, I think that things are also turning a lot better for other parts of the world. And predominantly Asia and emerging markets, I think there are great opportunities. And so if I think about it, there are really 3 areas that I would pay attention to if I have to zoom into, for instance, Asia and emerging markets, which is a lot closer to home. I think one is definitely corporate governance reform that lead to better capital allocations. We saw that play out in Japan, we saw that play out in Korea, and now China. It's also sort of adopting to that playbook. And so at this point in time, some of the Chinese SOEs are paying dividends of more than 5%. So I think today's topic is income and growth. So you have that income element from that capital allocation discipline, which is getting a lot better in Asia. Another area, it's AI. Hugh sort of touched a little bit about that earlier on about productivity. And we are seeing a lot of great opportunities, not just in US when it comes to AI. Again, going back to NVIDIA, it's the AI GPUs, and that's really where a lot of imminent investment opportunities orient around. But do you know the utilization rate of AI GPUs at this point in time is only about 30 to 40%? And that's really due to memory constraints. So some of the high bandwidth memory producers, essentially there are three, two of them are in Korea. So those are the companies that could benefit from this AI proliferation. Those are investment opportunities in Asia. And if you look at Southeast Asia, a lot of the AI assembly, testing, packaging are companies in that space. So again, on AI, I think is an area that presents great investment opportunities. And then finally, it's a consumption upgrade and urbanization. Then sort of move a little bit away from Asia and go to Latin America. Some of the companies like Mercado Libre, e-commerce, Nubank, and financials. These are the companies that continue to capitalize on the long growth runway of penetration, but also consumer moving up the upgrade cycle. So I think there are just a lot of opportunities, and I could talk more about Europe. I think Europe investors shouldn't be writing that off, but essentially diversify, not just US. US will continue to be quite exceptional, but other regions are catching up.
Let me just a follow-up question on that to dive a little bit deeper into North Asian markets. Hong Kong, China, Japan, Korea has done very, very well this year. What are some of the key drivers that you're looking at to see if this is going to continue next year?
That's a crystal ball question, and unfortunately, I don't really have one. Again, in Capital Group, we tend to have more views on companies rather than on the market. But I know that if I put a full stop to that, you're not going to be happy. You are not going to be happy. So this is how I think about it. I think the Hong Kong and some of the closer regional markets like Korea and Japan, they've been doing very well. Whether it could continue that momentum, a lot of factors are going to go into play. But for me, I think it's really down to two, and that's really earnings growth. And once again, something that I mentioned earlier on is capital allocation. If you look at Hong Kong, China, using MSCI China as a proxy, year to date, more than 90% of that really strong return that I think some of the folks here are definitely enjoying, is really coming through from valuation expansion, followed by dividends, and then lastly, earnings growth. So going into next year, whether Hong Kong, China equities can continue that really strong rally momentum, where it depends on whether earnings growth can deliver, because valuations just have a much higher base to stretch going into next year. And then on capital allocation, as I mentioned earlier on, Japan, for instance, part of the reasons why it's done very well is because, right after, I think it's March 2023, when Tokyo Stock Exchange introduced the corporate governance reform, urging companies to really improve on their valuations, improve on their profitability, and winding up the cross-share holdings. And that led to companies starting to buy back more shares, increase their dividend payout, and that playbook has been playing out. And Korea, sort of, again, similar trajectory. You have the value add program that tried to close out the Korea discount. And so you also see these companies in Korea doing very well. And obviously, they get that high bandwidth memory, the AI exposure. And so I think these would be the factors that would drive these companies in these regions on whether they would do better or not. But I know that it's more closer to home. But again, if I can talk a little bit about Europe, I'm just really excited about Europe. If I look at our global equity strategies that have been doing quite well over the last 3 years, we're actually quite overweight in Europe, and it's really driven by bottom up, and it's really driven and underpinned by the fact that we're just finding a lot of great opportunities in Europe. But if I can just take a step back and look at the macro level, I think what this year has changed is under Trump 2.0, a lot of narratives about make America great again. But who knows? Now these days, it's making Europe great again. And so at a macro level, on the fiscal side, you see that there is a whatever it takes 2.0 moment for Germany. You see defense spending probably going up from 2% of GDP to about 3 to 5% of GDP, and that would help the macro backdrop. And then you have the monetary policies continues to be very accommodative. And then on a fundamental level, just valuations a lot cheaper, earnings growth is starting to move the needle, and great secular trends, reindustrialization. And within Europe, you have aerospace, you have defense companies, and then you have European banks as well, which is suddenly coming back into the fore. And so I think there are just a lot of opportunities. And so be diversified, and so not just the US, but closer to home, Asia, or even in Europe. There are just a lot of opportunities from a bottom-up standpoint.
Thank you, Andrew. Maybe just shifting gear here a little bit to talk about U.S. debt markets and private credit. Right? We've recently seen a few high-profile defaults, and this quote's been kind of making its way around. But Jamie Dimon has talked about cockroaches, right?
That there are fewer cockroaches in the market, and we should expect more to come. Right. So, Jingjing, how widespread are these credit quality issues? Are you seeing stress concentrated in kind of certain sectors of the market?
And how does this compare to the opportunities you see in global credit?
Sure. So back to the cockroaches issue. If you understand, I guess many of us have seen cockroaches in Hong Kong, right? If you understand where cockroaches live, they are concentrated. They're mostly in the humid, dark corners. And I would say that's probably the same with all the issues. We don't think these are systematic. We see the issues mostly in the low quality, weaker pockets of the market. So similar to cockroaches. So I have to say that's a pretty accurate analogy. But where are we seeing that? These are mostly in the highly levered companies, low quality, and like subprime loans, autos, and some of the lower quality mortgages. So the reason we're seeing that was really because when the market was what we call the easy money era, which means it's much easier for the companies to get funding. So they tend to take on a more aggressive approach. And that was totally fine when the rates were low. However, now we're in this new era with higher for longer. So when the rates become higher for those companies who borrowed at floating rate and at covenant light structure, and also with some pay-in-kind loans, their burden, their debt pressure becomes bigger and bigger. And that's one of the risks we have been highlighting to the market, because really understanding how the companies, the fundamentals looks like would help us to avoid these cockroaches. So the recent high-profile defaults, we actually were able to successfully avoid them as a result of our solid fundamentals research. And where we're seeing more of the opportunities within the private credit space, we actually think that the asset-based lending will be more interesting than just the direct lending. So where we are focusing more on is asset-based lending in the aviation sectors, data centers, and also logistics centers. And these are where we're seeing the more secular trend. For example, the aviation asset-based lending. These are the aircraft lessors. So they own the aircrafts, they lease to the airlines, and we fund these companies, and these are backed by the assets, which means anything goes wrong with the company, we can take over the aircrafts, and we know exactly how much they can be sold to the market, and that's exactly our downside protection. That's the recovery value. So these are the more healthier sector or the higher asset coverage sectors that we wanted to focus on within the private sector. And also to the concerns in the commercial real estate market, we are seeing the weakness in some part of the commercial real estate, for example, in the offices and the retail subsectors, because these are really facing the long-term changes in terms of the demand shifting. People's shopping behavior, customer behavior is shifting. So the demand for office spaces, for retail shop spaces, these are structurally changing. That's why we're seeing the weakness. But there are also areas where we're seeing more strength for example, in the multifamily and also logistics centers related to what Andrew just mentioned. People are trying to get on the upside of AI, and one of the areas for that is like data centers. And also with the global shifting of the whole like logistics trends, these are where we're seeing the subsectors that's attracting more capitals. So being really selective and understanding the fundamentals is the key to investing in private credit.
Thank you. And a question for Hugh on private credit, because it's obviously an asset class that has been, very attractive for our clients. We've seen a lot of interest. We launched our Endowus Private Credit Fund earlier this year, and there was a lot of demand. But given the recent kind of headline news on private credit, First Brands, most recently Blue Owl as well, what are your thoughts, and what is the role of private credit in a client's, income portfolio at Endowus?
Sorry, before I answer that question, I'm gonna talk a little bit about equities because I was expecting an equity question as well. and it's gonna be short. The only reason I do this is because in my previous life, I was an Asian equity investor myself. And I have some colleagues from here doing Korean equities. But Korean equities has probably been the strongest ever, I think, that I remember relative. And I think there's some pretty structural changes that are happening in the region, including Japan, Korea, and I think Singapore is actually trying to follow that as well. As you said, China as well. So what I think is interesting is that Asian equities overall, including China, Japan, Korea, are probably one of the most liquid markets outside of US and Europe. So it actually does represent a pretty credible alternative to US equities, which I think we haven't really seen in the past. Europe is obviously one of them as well. So from our client perspective, they always ask for credible alternatives. So I think that's very important. But I think it's also very important to stress that it's not one or the other. I think US equities are core because they are at the center of innovation as well as productivity growth. If you compare, and you were mentioning Europe as well, but if you compare European and US equities, one of the key differences recently is that the R&D per sales has been dramatically different between different regions. So there's a reason why ROEs are much higher and so on and so forth. So I agree with Andrew. I think the base case, you have to look at it from a diversified perspective. Now, going back to the private credit question, I think it's important to understand that, again, private credit is actually a pretty big universe, including not just direct lending, but asset-backed and a lot of different, if you think about it, it's really lending towards all private companies. Private companies collectively have more than 70% of all global revenue. So I think we should focus on certain news flow, but not get overwhelmed by them, because a lot of times news flows tend to be very sensational. So I agree with Jingjing that there's probably not a lot of systematic risk. I think the reason private credit grew a lot recently has obviously a lot to do with the fact that banks can no longer provide that kind of funding for a lot of these companies. Plus, there was a very big growth in sponsored lending because of private equity growth as well, right? So, and a lot of companies are staying private for longer, right? So, to your question, is this a long-term asset class to say? Absolutely, I think, right? And so I think, yes, you have to be very selective, you have to be very mindful, diversified, and therefore, even if there are blow-ups, the overall portfolio, should be fine. But you can't expect like an immaculate zero default. That's just not going to happen, right? So I do think that private credit is still a very important part of client portfolios. Now, you don't want to have everything in just direct lending. It should be in asset-backed and different, types of strategies. But I do think that it is a critical part of financing private companies, and therefore it should continue to be very relevant.
Yeah, I think Hugh, you made a very good point. I just want to add one point, which is also quite well discussed right now is the convergence between public credit and private credit. And the way people should think about it is really there's no clear line between whether it's public or private. It's more about how you justify the valuation or discover the relative valuation, considering all the factors, including the liquidity you're getting, the structure complexity you're getting, the fundamental risk you're taking. With all these considerations all together, and look at the valuation, which one makes more sense. So eventually, it's going to be the same way of analysis and the same framework of investment decision.
Thank you. I'm going to go back to the title of our event today, which is income and growth, right? And how to position for that. And back to Jingjing. So we know that PIMCO's expertise is really in fixed income, but for clients who want more upside, right? How would PIMCO approach this?
Thank you. To be honest, when I saw the title of today's event, I saw that's designed for PIMCO, because this year our best-selling fund is called PIMCO Balanced Income and Growth. This is a balanced fund with a approach that's like 60 equities and 40% global fixed income. So this is a more balanced way and also a more traditional way of asset allocation, because when you were introducing Endowus, I think it's exactly the mindset. Like 60-40 is exactly how like institutional investors, like the endowments, like the insurance companies would start with. And this is an approach that can help people to really stay invested and then stay balanced, because in the market with more uncertainties, the cost of timing the market, going in and out of the market, and also trying to rotate the factors that you're investing, the cost can be very high, because it's very easily you get any like factor wrong, then that's really the opportunity cost you're leaving on the table. So using a more stable approach and allocating across fixed income and equity, and then focusing on the high quality part within the fixed income and equity, we also take the more globally diversified approach, similar to what Andrew introduced. This is really a way for people to focus both on income and growth. So income is really, I can't say guarantee, I'm sorry. It's not guaranteed. It's provided sustainably by the high quality assets that you have within the portfolio. And the growth really comes from the risk you're taking and the equity beta you're taking from the market.
I promise we didn't rehearse that.
A question for Hugh, and it's the last question before we jump into Q&A, but what are the top, two considerations for
investors that are trying to build a resilient portfolio for both income and growth?
Yeah, I think the first thing to think about, whether it's income and growth or resilience of a portfolio, is I think you need to understand what your goal is, right? You have to. That's what Jingjing was saying earlier on. You have to figure out what you really want, right? Not what your friend wants, not what looks good, but what you want, right? And I think that's the starting point of every portfolio construction. But with that in mind, I think the income portion, like Jingjing alluded to, I think should be, it should be a very regular, predictable, high quality type strategy, right? And we have, including PIMCO income as well, but we have a lot of different strategies there. I think the growth part, like Andrew alluded to, should be, should have a lot of different drivers of growth. It can't just be one region, sector, etc. So again, it's going to sound very boring, but that diversification, I think, is very, very important, right? So the quality and diversification probably are the 2 points that I would mention. But one last thing to point is that actually one of the panels that I was moderating at our recent conference in Singapore was called Beyond 60-40, kind of, adding alternatives, etc. Now, there was a lot of discussion among the panelists because a lot of them were very sophisticated, very experienced professionals. And there's clearly, like 60/40 is not perfect, right? And we've seen that in 2022, right? It was a very difficult year. But the reason why it's still very effective is because it's very simple. And it also does the job over a long period of time. And that's why for most individual investors, it's still a very, very effective tool. However, given you were saying resilience, I do think that there are other things if you do have the access and the knowledge and so on, to add other things, such as infrastructure or other alternatives that will make it even more resilient. So I do think that the income and growth of the 60/40 is a very, very good starting point. Quality and diversification, I think, is two key areas, but if there are other things that you could add to make it even more resilient, I think that would be even better.
Thank you. Let's open up the floor to Q&A now. If you have any questions for our speakers?
We just discussed about the rate cuts in coming year, but I mean, how about the inflation? Because like we talk about high credit, counter credit, and I know infrastructure. This time mentioned infrastructure. For inflation, infrastructure may somehow performs better than the other, assets class. So, and in coming years, we talk about the rates only going down more likely. Does it mean that public credit and private credit will outperform infrastructure? Thank you.
I can talk about inflation first and probably leave the other questions to the panelists. So our base case is we see the determination of the Fed to bring inflation towards the target of 2%. How long will that take? It really depends. And also, like, tariffs is another factor. Like, how quickly is the cost being reflected in the inflation? And how comfortable is Fed cutting rates, even if it's not 2%? And we think in general, as what we have seen this year, 3 point something is already the range for the Fed to start cutting rates. And then towards the end of the next year, we think towards 3% of inflation, that's a reasonable direction. And then between 2 to 3%, we think probably more likely on the higher end of this range towards next year. But again, this is one thing that we are closely monitoring because the stickiness of inflation is going to impact the macroeconomy.
Okay. Well, on inflation, I think just a little bit more to add to what Jingjing has said. I think right now at this point in time, it's tariff, but also it's about how AI adoption could move the needle on productivity, which is something that Hugh said, which could have an impact on inflation. So at Capital Group, we like to draw a lot of different scenarios, and I think, just thinking about on tariff, actually quite a bit of that effective tariff rate hasn't really factored into the economy at this point in time. So when we see more of the effective tariff really feed through into the economy, so that could potentially make the inflation a lot stickier, if not a little bit higher. But then if the adoption of AI could really improve productivity, actually our economist was just thinking that there is a potential for productivity growth for the US to go from currently about 2% to 4% in the next 5 years. And that could sort of help bring inflation down from the current 3% to a bit lower and potentially edging towards that 2% target. And so if that's the case, then that inflationary concern that a lot of investors have because of tariff would become a lot less of a concern. How does that impact equities? I like what Hugh mentioned early on is you can't really construct an equity portfolio based on how you think about rates or how you think about inflation. I think a lot of investors have done that over the last 2 years. And was it a great outcome? Not necessarily. And so going back about building a core portfolio when thinking about investing, constructing your equity portfolio, I know that I didn't get the question about income and growth, but how we think about income and growth is really focusing on quality companies from an equity investment standpoint. Because if you invest in quality companies, these are the companies that are paying a sustainable level of dividend, but at the same time delivering growth. But when winter comes, they could still manage to hold their margins relatively resilient and still offer that dividend. And so what we're looking at is, balance sheet strength, sustainability of earnings, but also the free cash flow generation capability. And so all these sort of inform how quality that company is. And we're talking about not just in the US, not just about those AI companies, but essentially across the world. That's how we focus on quality, and quality gives us, income and growth. And one more thing that I want to bring out, it's how to assess quality is really through active investing. Last year, we've done more than 21,000 company meetings around the world. Assuming that we have 250 working days, that means that every day we're meeting with, we're doing more than 80 company meetings. And that's really helped us identify what are the quality companies, what are not, what are the structural winners, and what are the outsized loser. And I think a really great example is, I know that we haven't really touched a lot on AI. There are a lot of debate about whether we're in an AI bubble or not. But for us to understand more about AI, Capital Group actually organized an AI summit recently. And we invite a lot of companies and their senior management coming in. So we have Sam Altman from OpenAI. We also have Daryl Amolde from Anthropic. We also have the CTO from Microsoft. We have Meta coming in. Just trying to understand, what really differentiates the AI winners and the losers going forward. And so that's how we sort of identify quality companies. And these quality companies will be able to navigate an inflationary environment a lot better, or different rate scenarios a lot better than the non-quality companies.
Just on the relationship between inflation and infrastructure, I don't think there is this linear relationship where, if inflation is higher than expected, then infrastructure outperforms and vice versa. I think the reason why people think about infrastructure as an inflation, I wouldn't say hedge, but protection, is just because of the way a lot of the contracts are done, like whether it's a utility or a toll road or whatever. If you can pass on the inflationary pressure down to the pricing, then that's why it's. But if you look at some of the things that are happening, and when I say infrastructure, it actually means infrastructure equities. So it's actually equity on the infrastructure asset, right? So it's not just toll roads and utility and so on. Now a lot of infrastructure are data centers, right? It's fiber, right? So a lot of them are growth infrastructure as well, right? Which then doesn't have the same linear relationship with inflation as well, right? So some of the private infrastructure products that we're looking at the moment have expected returns of, let's say, 10 to 12%, and they obviously act like equities, but it's just not as sensitive to GDP growth as normal corporate private equity, right? So I just mentioned it as an alternative, as opposed to necessarily something better or worse, etc. It's just that real assets, including infrastructure, tend to have better protection of inflation, particularly during periods like 2022 and so on and so forth. But I agree with, again, the base case that there is this kind of mixed force between tariffs and deglobalization versus technology, AI in particular, kind of really becoming a deflationary force because of the productivity growth that you're seeing. So again, it's a little bit of a cop-out because I just don't know, but I think most people don't know what's going to happen, and I think that's why it's very important to have this diversified approach.
Could you comment on currencies? Because I imagine Europe, Asia, Japan, Korea, there's a lot of currency risk there that needs to be managed. What's your view on that?
Again, I'm not a currency expert, but I'll try my best. So I think I was going to answer, first of all, on the whole US dollar part first, right? Because I think we did have a macro presentation during our big conference a few weeks ago as well, which is that I think a lot of the dollar view has been on US exceptions, right? Like, is that broken, right? Because what is U.S. exceptionalism? It basically boils down to, can U.S. grow faster than others relative to history and so on? And we have seen that over the last 10 years, and because of the hyperscalers and so on and so forth. And that's determined one. But if you look at currency, fundamentally speaking, it's really about, purchasing power and parity, right? And versus other. So that's also related to the interest rates of different markets. And if you look at interest rates, I'm going to borrow a study from another firm. Just fundamentally speaking, I think it was saying that, U.S. dollar is a little bit expensive still relative to a basket of all the rest of the world. But if you look at what's happened in the first half of the year, it's definitely moved not in sync with the relative yield, right? Meaning a lot of it was very driven by flow, which is probably because of a loss of confidence, because of tariffs or whatever else that happened, right? So that's why our view, because we don't have directional view, was that you can't be too negative on the dollar, because a lot of cases near-term moves on currency tend to be driven by, consensus, and then if you're in consensus, normally it doesn't work out very well. So one of the key questions that we have in Singapore in particular, because a lot of the Singapore clients have, it's less of a concern here because Hong Kong dollar is pegged to the dollar, US dollar, but in Singapore, if your Sing dollar equivalent returns are terrible, people are like, what am I going to do, right? So it was a real question to us, and our general answer is that our policy for our portfolio is that we keep the equity portion unhedged, and we have the fixed income portion generally hedged to Sing dollar. And the reason is because, again, fixed income has fixed income. We want to have that fixed portion to be a certain dollar amount that comes in that currency, and because of it's less volatile, it's actually easier to hedge as well. Whereas for equities, it's very difficult to hedge that volatility, and historically, you've shown that the hedging cost is larger than the rest. So I know I didn't give you a view on each currency, but I do think that the kind of pessimism around U.S. dollar in the first half of the year was a little bit overdone. We're seeing an unwind of that right now. Obviously, the U.S. Government probably is incentivized to gradually depreciate the dollar, if anything, because of the debt and so on and so forth. But one of the things that we presented during the conference is that, yes, debt is really moving higher and so on, but if you look at it from a total balance sheet perspective, the assets have grown even faster, right? So I think you have to look at things in perspective, and again, not just on headline and so on and so forth. So just lastly, from my perspective, I think currency should be not the primary concern. It should be like, do you want to be in that asset itself? So there needs to be a difference between US dollar and US dollar assets. And if you feel that you want to be in US dollar assets, whether it be treasury or hyperscalers or whatever it is, you need to be prepared to have US dollar exposure, right? You can't just have, one sliver and expect everything else to be free hedged. There's no such thing as a free hedge. So I don't know if you want to add anything.
Yeah, I'm happy to also add on to that and share how PIMCO managed the currency exposure more generally for our portfolios. First, on dollar, we think that the reserve currency, the dollar, is still going to be that position, and dollar assets is, despite all the discussions, it's still going to be the cleanest dirty shirts. And that probably already says like our overall positions. And then on the FX overlay, I agree with Hugh. Like, do not rely too much on your FX risks, because a small portion of that in the portfolio is going to bring a lot of volatility to the broader portfolio. So how we manage it is actually you are going to have your base currency, and then on top of that, we execute some of our high conviction currency relative value trades. For example, we have our currency baskets, the foreign currency carry basket. What that means is we short the low carry currencies and we long the high carry currencies. So naturally, you already get the differential. And the low carry currencies tends to be the Asian currencies because these are the countries with lower interest rate. So you borrow at low interest rate, and then you lend on high interest rate, and you receive higher interest rate. So the higher carry currencies that we have in the baskets tend to be the emerging markets like South Africa, Brazil, Mexico. So these are the relative value we discover in this market. Of course, that can change very quickly, and that's going to bring you volatility. But having that relative value mindset is going to help you to take on some of the additional alpha opportunities.
If I can just quickly add, so for our funds, we do have different currency hash share classes. So in case if you have a certain view on a specific currency, there are options for you to access in your preferred currency exposure. But I think just a little bit more things to add. It's if you look at year to date, US dollar has really depreciated really kind of only against euros versus other currencies. They're actually doing relatively okay. So I think is really where euros would go from here, and I think that there are actually quite a bit of positive drivers for euros going forward. And actually, there could be chances where ECB could be raising rates next year. And I think that would be a very interesting dynamics and implications on euros. But going back to US dollar, I really agree with what Jingjing and Hugh just said. Wherever you're investing, you will have exposure to US dollar. And how we think about US dollar is that the reserve currency status, what Jingjing mentioned early on, it's in the medium term. I don't think that's being challenged. The second is FDI. I think what Trump and the U.S. administration have been doing is to bring a lot of foreign direct investment into the U.S. And we've seen those data centers investing. You've seen the healthcare companies investing. Manufacturing is coming back, and I think that should give quite a bit of support to U.S. dollar. And finally, just the U.S. dollar assets appetite coming back, not just in fixed income, but also in equities. So I think there are still some structural elements to support the U.S. dollar. But that being said, also agree that we're seeing this slow depreciation trend for U.S. dollar because of the overvaluation, and I think that that's something in the shorter term might continue. But still, the structural element to support U.S. dollar is still there. And finally, I think from an equity investment standpoint, currency risk is something that we factor into every single company that we invest in globally. But that's not the only factor that we think about. And even if you think about investing in a Singapore domicile company, they would have U.S. dollar revenue exposure. They would potentially have renminbi costs input exposure, and so you just have a lot to go into it. And so that's something that when we invest, we sort of put into perspective.
Two guests, I'm just wondering, so both of you are prominent active management funds. So I just wonder for your flagship funds, actually, where are you mostly underweighting, which suggests that you see some, say, dangers ahead, for example? Because we have been talking, things have been going on well for quite some time. Just wonder, in this context, maybe some wording will be helpful for the audience. Thank you.
Yeah, I can start. If there's one sector I wanted to highlight tonight in terms of the risk we're seeing, I would say it's really the low quality high yield, which is below investment grade assets. And also apart from the double Bs, that's the high quality of high yield, that's where we're seeing more interesting opportunities. But anything below that, we think the market is also not pricing enough of the risk people are taking there. And the reality is many of those issuance are also the issuers have been emerging and evolving over time. Some of them has gone into the floating loans market. That's another area that we want to be more cautious on. but overall, the lower quality corporate funding channel, that's where we are more careful.
We do have quite a number of flagship strategies on the platform of Endowus, but if I can use one, going back to our core global equity strategy that has been running for the last 52 years. At this point in time, I think what's very interesting to highlight is that we are underweight US, we're underweight tech. Now, we're not only doing this year, and if I go back a couple years, we've been underweighting US for quite some time, and we've been underweighting IT for quite some time. Has that compromised results? Nope. We actually did deliver really strong returns over the last few years. And that's really driven by bottom up. And it's just that I mentioned early on, we're finding great investment opportunities in Europe. And we're also finding great opportunities in industrials and healthcare, for instance. But does it mean that we're having a negative view in the US? No, I think we're still finding great opportunities in US. Are we not buying into the AI theme? Definitely not. We're investing in the AI stack as well, but we're really selective in what we're investing in the most expensive and the most concentrated part of the market. And that's really because those are really pretty much well understood by the market, and what we're trying to identify is really the next winners and the next global champions. And we are currently finding some of them in the tech sector, but also in, I mentioned earlier on healthcare and industrials. But quite interestingly is that we're underweight US and underweight tech.
Any last question from the audience? No? Okay, if not, then I will end on a quick fire question for each of you. One piece of advice for the audience
To navigate 2020.
One.
top piece.
Okay. Stay diversified. Go global.
I know it sounds cliche, and I'm not being flip about this, but it's really timing the market, not timing the market.
Yeah, I think it's very similar. Just say, stop looking at the news. Yeah, tune out the noise.
Okay. Thank you so much for speaking tonight. Really, really appreciate Jingjing and Andrew joining us on this panel. I wanted to actually show one more slide, if it's okay. Just a quick blurb on what is actually on the Endowus platform to end the night. For those of you who are a little bit newer, we offer everything from cash management products, public equity, fixed income, in our advised portfolio. So we have our core flagship globally diversified portfolios. We have income generating portfolios, satellite portfolios, if you want to take a more thematic view, as well as private markets and hedge funds. So that's private credit, hedge funds, private equity, private infrastructure, as well as our fund platform. So for those of you who know what you want to invest in, you can also customize and build your own portfolios. So we have wonderful managers like Capital Group and PIMCO. We work with about 100 managers in total and about 300 or so of their strategies. Yes, these are some of the logos of the fund managers that we work with and the different asset classes. And we talk a lot about keeping our fees low and fair. So this is our fee structure. We charge a very transparent all-in fee that's based on how much assets you have with us. No additional transactional fees, so no upfront subscription fees, no fees when you redeem. And it ranges from 0.1% for cash management products, 0.25 to 0.6% for general strategies, and then 0.4 to 0.6 for private markets. Don't have an Endowus account yet. It only takes a few minutes. And now that we've linked up to I Am Smart, it's even more seamless for you to onboard. Just try it out.
It's very smart.
That's right. We just launched it a couple weeks ago, so it's very exciting. So even though we are a digital platform, we feel that wealth is something that is very personal, right? So it's a hybrid human digital experience on our platform. We have a team of client advisors that is always available to talk to you, meet you for a coffee if you need any help on your investment journey. A few of them are actually here in the room today, so feel free to reach out to them or to myself if you have any questions. Oh, we did that. And lastly, here is a voucher for you to sign up today. You get $300 off your fees if you don't have an account yet. So I will leave it on this screen. Thank you everyone for joining us tonight. We're gonna stick around for a little bit, so if you have any questions, please feel free to come over and ask. Thank you.